Well, now you've heard a lot about the HUD programs, the principal programs for refinancing or equity takeout. I mean, when Evan talked about 223F, that's for acquisition, or it can be used to pull out equity as a refinancing. The other two programs you talked about is just refinancing. The A7 program allows you, basically, there's no equity takeout in A7, but it allows you to go up to put the money in the reserve for replacement account. And so if you need capital needs. And the last program you talked about is great if you don't need any capital improvement, because it's expensive. The costs involved in doing an A7 are similar to those of an F. So you've got really a good investment in there. But the beauty about the A7 is it's almost free. It's, if you don't need any capital and all you need to do is reduce your interest rate from 6.5 to 5, boy, use that and it's just a paper transaction. The other thing that you heard Evan talk about, and for those of you, HUD, since the financial crisis, HUD has been looking more into its value of its portfolio, and it's been very cautious. And what Evan was talking about was HUD Notice 1227, which changed the world. It truly changed the world as far as PCNAs go. It will be much more costly. There are much more intensive rehab requirements than under the old PCNA requirements. Look, when I was at HUD in the 80s, for as far as an A7, there was no PCNA. It was back of the envelope. The developer came in, he said, I want to put on a new roof, I want to fix my elevators. We said, here's your $1 million. That world has all changed now, and 1227 formalized it. It's changed in New York because the various people who are running the New York office kind of changed, starting with Deborah. And we had to put PCNAs, but it wasn't really a Washington requirement. But now it's really formal. So if you haven't had the lovely experience of having to do under 1227, I mean, they're really intrusive. It's much more expensive, and it takes much longer. So that's it. But there are those good programs, and there are none of the guarantees that other programs have. We'll now hear from Michael Edelman, who's with Beach Street Capital. Beach Street is a rather new HUD mortgagee. It required, I think it's Eagle from Sovereign, right? Yeah, from Sovereign eventually, and it bought it and it's new. And the head had a great fortune of meeting, and now the name's Margaret?
Grace.
Grace, a wonderful woman who's the head of the firm, and she was at Fannie Mae for a long time. So she really knows Fannie Mae. And with Michael there, who was at Freddie Mac for 15 years, they've got their bases covered. They really have their bases covered. They have some FHA experience, but the people that work there, a lot of them are Fannie Mae and Freddie Mac people, and they really know those alternatives. And when you hear HUD speak, no one's going to beat the interest rate for a 35-year fully amortized loan. But you heard about I'm sorry that I mean the HUD people here, they really are trying, and they are trying to get loans out faster than the 6-month, 9-month process that it now takes between going to your mortgagee and getting it out the door. They're not there yet. They're trying really hard. They're reorganizing. They're doing what they can. But look, I spent 8 years at HUD. I adore HUD, but the process is tough. I mean, you have your things, when the good goes bad. And there are times when your deals just don't allow that. We had one a couple of years ago. We came in for the FHA. We wanted an F to refinance. I had to pull out equity because I had a hard lock on another deal in June. They come to do the physical review, and they say, well, we'll get to it. We think we'll get to it in August. Well, had to turn around and do Fannie Mae. And Fannie Mae gave me my money so I could close on this other hard lock deal within 2 months. And there are times when you just need to do that, and you have to understand what the alternative programs are, even though they're just different. And with that, I'd like to introduce Michael Edelman, who will go through those alternatives that you might need. They also give you 5-year interest-only money and other things.
So a little history of myself. As Hunter said, I was at Freddie Mac for 15 years. The last 5 years I ran the New York office. Freddie Mac is set up regionally, and there are 4 regional offices: New York, Chicago, DC, and LA. And the way that they operate is based on where the property is, that's where the deal gets underwritten, size, the relationships, sort of hatched in that local office, so it's more of a local delegated program to those offices. And the New York office covered Pennsylvania through Maine. Again, I was there 15 years. We built a $45 billion book business in that period of time. Basically no defaults. We had one co-op that pays 30 days late every month, but that was the only slow paying transaction or default that we've had in that period of time. So that's my sort of history. In 2011, I transitioned over to Beach Street Capital. Beach started in late 2009, booked its first loan in 2010. And the growth of Beach in that period of time, obviously timing's everything, and it came into the business at a great time for the agency business. So in 2010, we did $1 billion. 2011, we doubled to $2 billion. 2012, we doubled to $4 billion. And now we're probably on target to do a little over 4 this year. Hopefully, 4.5 is our goal. We'll see how that plays out for the rest of the year. And just about 3 weeks ago, we announced news that Capital One is actually buying Beach Street Capital. So that is going to offer a lot more opportunities. As I go through sort of the history of the agencies and how that business has been evolving and what the future is for that business, which clearly is in play right now. Having a bank balance sheet, as Evan has an insurance company balance sheet, having a balance sheet there really helps a lot. And among some of the things like for instance, exactly what Hunter was talking about, when you have an acquisition or you have to close quickly on a HUD deal, it's difficult. So a lot of lenders, and we're going to be one doing that as well, have a program called Bridge to HUD. So you basically close on an acquisition in 30, 45 days, put it on a bank balance sheet or our balance sheet, and then you go through the HUD process, and in 6 to 9 months you get your HUD commitment and you close and you pay off that bridge loan. So having a balance sheet affords a lot of lenders a lot of opportunities that complement both agency programs, Freddie and Fannie, as well as a HUD program. So we should be closing with Capital One before the end of the year, and we're excited about it. It gives us a lot more executions than we have right now without a big bank balance sheet behind us. So I'll just go through a little bit of the agency 101. I'm assuming this is a New York crowd, correct? Is that okay? Any experience with Freddie and Fannie here? Okay, as well. Just basically, Freddie Fannie offer the suite of products. It ranges in terms from 5 years to 30 years. The products that the properties that they finance range from co-ops, Section 8, market rate. They do a big book of student housing. They do a big book of senior housing with the continuum of care. They do tax-exempt bond credit enhancements. Manufactured housing is also another big book that's written nationwide, and they obviously are nationwide lenders. And the other advantages of an agency deal is sometimes, I think you correctly pointed out, the prepayment on a HUD deal is a step-down prepay. Agency is either a defeasance or a yield maintenance formula. But in conjunction with that, they also offer essentially an assumption process. So if someone buys your property during the term of that mortgage, it's assumable. They offer a supplemental financing program, which if there's a big increase in NOI and you want to re-lever the property and you want to come in for more proceeds, you can come back and what we call take another bite of the apple and basically re-lever that program, the property, take what's called a B note, and your A and B note go coterminous. You lever the property up, and it works very well with assumptions, because if you're selling the property, someone's coming in with fresh equity, they could assume your existing loan, you avoid the prepayment, and they come in for a supplemental financing to get up to 75-80% leverage on the property. So that's sort of the suite of products. Some of the little nuances. One thing is interest only, depending on the leverage of the deal. Full leverage deals maybe get a year. If you go below 65% leverage, you can get full term interest only. So that saves obviously on amortization costs. Where rates have been lately, the amortization really has been ticked up with 3, 4, and 5 handles on interest rates. Amortization has really been pretty big. So interest only has been a big advantage over the last few years. Agencies are cranking along, and then the financial meltdown comes, 2000, 2007, 2008. Basically, they're left as the only lender in town. And Less so in this market and more so elsewhere in the country. I think, you know, the coasts are unique that there are a lot more lenders who play in these markets for multifamily properties. New York, by far the most unique because you have all the banks, you know, chasing each other and beating each other over the head with interest rates. California has a little bit of that. I know Chase has a big presence there, but you know, in between and definitely down south and southeast, it's an agency market. It's Freddie, Fannie, and FHA. So, you know, 2000, 2007, 2008, they had record years. They really stepped up, and with all the bad press about Freddie and Fannie, how it sort of, you know, facilitated the housing crisis and the meltdown. While I'm not here to comment on if that's true or not true, it's definitely resonated more on the single-family side. The multifamily book has been performed great. You know, minuscule delinquencies and defaults continued through the housing crisis of making money. If you segmented the book's business, I think when I was at Freddie, I think the single-family side lost $40 billion, and the multifamily side made $2 billion in 2008. You know, when you sort of combine that together, they lost $38 billion. But the reality is, if you sort of segmented those businesses, they really were continuous to be a profitable arm and a profitable business. So anyway, they go into conservatorship, and the Federal Housing Finance Agency is their regulator. And then, you know, the rhetoric starts picking up over the last year and a half about the agencies and the future of the agencies. They're trying to sort of segment the multifamily business from the single-family business. That's happened to a certain degree, but not 100% where they're going to be totally separate businesses. And the Federal Housing Finance Agency says, okay, we want you to reduce what you do in terms of business. So in 2012, the agencies combined did about $62 billion in business. Federal Housing Finance Agency says in 2013, we want you to reduce by 10%. And going forward, you know, who knows if that's going to be another 10% reduction, but in 2012, they've been mandated, in 2013, I'm sorry, been mandated to do $56 billion, a 10% reduction, give or take. So they're essentially have a volume cap, and they're managing to that volume cap right now. Now, you know, when you're driving a big warship, it's very difficult to stop on a dime. So, you know, this year's been a little challenging. There have been times when they've been aggressive, and at the beginning of the year, their pricing has been kind of the best in the market, and they filled up, and they were at a run rate that was going to exceed their allocation for the year. So over the summer, in conjunction with treasuries moving up, their spreads have moved up, and they've tried to slow the battleship a little bit. I think they've actually overslowed it now, and now they're coming back and being a little more aggressive. So, you know, the long and the short of it is, you know, we do this every day, and you kind of know the nuances of what's good on pricing, what's hot, and what's not. And, you know, the last probably 60 to 90 days have been you know, difficult to get deals with the agencies done, and now going forward, I think they're starting to lower spreads because they're looking at, they want to close some deals before the end of the year, and they want to firm up their pipelines for 2014. So, in fact, Freddie Mac on Monday reduced 15 basis points in pricing. So, the net result of what I'm saying is, you know, go with someone who understands that business well and could sort of navigate you through what's better on a Freddie or a Fannie and the timing throughout the year. But you know, the agencies have been mandated to reduce their business last year. They've done that this year, and they're going to manage to a certain goal. One of the other mandates for the Federal Housing Finance Agency is to finance what they call VLI units, very low income units. And that is units where residents earn 50% of AMI. So there's been a big push this year from both sides of the agency shop to do VLI units. And you know, VLI could be Section 8 properties is probably the easiest thing, where they look at the rent that the tenant's paying, the tenant portion of the rent, not the overall Section 8 payment. So they're looking at what the tenant pays out of pocket. So essentially all Section 8 deals qualify for that. You know, and then you know what they're doing to incentivize those deals is, you know, they're putting those to the front of the line in terms of speed. They're going to get aggressive in the underwriting, and they're going to get aggressive in the pricing. So I'll jump into that a little bit more, but that's just a little bit of the history of where the agencies are, what their mandates are going forward. And as you know, there's been some talk in Congress. There's a bill right now, a corporate Warner bill, which is contemplating the future of the agencies. It's got some tepid White House endorsement on that. And, how that plays out on the multifamily side still remains to be seen. But the bottom line is, I think what the agencies are focused on is, especially now when the conversation is going on, is to comply with all the Federal Housing Finance Agency mandates with respect to volume, with respect to affordability, and they're doing that. Just a little bit more background on the difference between Freddie and Fannie, because I get that question a lot. On Fannie Mae, we as lenders and authorized, we're what's called a DUS lender, delegated underwriting servicer. And in exchange for that designation, that license, we actually take a risk on the transaction. So a portion of that loan comes from our balance sheet, our pocket. If that loan defaults, it comes out of our pocket. So each one of the lenders has a capital allocation against loans that they make, and they're basically taking a top loss. And there's been talk about, with the regulatory environment, about having, quote unquote, skin in the game. That's the skin of the game on a Fannie Mae deal on our side. So a loan is made, we take a top loss piece, we take the remaining piece, and Fannie Mae guarantees that loan and issues a security, and an investor buys that security. And then that deal goes off into the market, it's sold to an investor, we continue to service it, and again, we maintain a loss piece on the top. Depending on the deal, it could be up to 10% there. So what you tend to see sometimes on the agency shops, and there's a wide range from the smaller, independently owned sort of mortgage banking shops to the PNCs and the Wells Fargos and the bigger banks, is their appetite for real estate exposure and their credit exposure on certain deals can vary. So you may have some lenders that'll do a lesser quality deal in a tertiary market, and they'll just price up for it, and certain lenders only want the A quality stuff in Manhattan. An extreme example, but the point is that there are differences on Fannie Mae deals if it's a delegated deal, and the majority of the deals are. Freddie Mac is exclusively underwritten and closed. It's closed by us, exclusively underwritten and bought by Freddie Mac, so we don't maintain a risk share piece on those transactions. What Freddie Mac does is we have a license with them, and we have a process where we bring transactions to them, and they make the overall credit decision, whereas on a Fannie Mae deal, if it's a delegated deal, it's our credit decision. So Freddie makes all those transactions themselves. Again, we service for them. What they do with their deals ultimately is they aggregate a pool of transactions, and they go and securitize that. That's called their K series. And in conjunction with issuing K series bonds, there's a B-piece investor, and they're taking the top loss. That could be anywhere from 8 to 12% of the overall security. And then they tranche out the rest of it. It's more like a CMBS execution. And so both these programs really, after the financial crisis, one of the other federal housing finance mandates, is, aside from doing less volume, is to reduce the balance sheet. And they basically use this vehicle, either individual security on the Fannie Mae side or a K series on the Freddie side, to reduce their balance sheet, reduce their exposure. So, again, from a user standpoint, it may be a fungible asset in terms of you're getting a loan and what's your interest rate and all that stuff, but behind the scenes is definitely a different process, and definitely a different different risk appetite that some lenders may or may not have. So just jumping back to Freddie Mac, so to the VLI push, I should say. So by virtue of what I just highlighted, where it's a delegated process on the Fannie Mae side, Fannie Mae's sort of advantage is they have what we call reach in the market. They have delegated lenders. So theoretically, if their business gets hot and they didn't have this volume cap and they were doing more business, the lenders would just beef up their infrastructure and they'd close more deals, and Fannie Mae would guarantee more bonds, but they don't actually look at every single deal. So by virtue of that, the average Fannie Mae deal is about half the size of the average Freddie Mac deal. They do a lot more transactions, a lot smaller transactions, and as just the market dictates, the smaller transactions in the sort of more tertiary markets just facilitate more affordable housing units. So Fannie Mae had no problem in their VLI goals this year. I think they hit it probably by June. Now Freddie Mac tends to do the larger transactions in the bigger geographic areas, the metropolitan areas with the bigger borrowers. Those tend not to have the VLI that they need. They do that because obviously when they're issuing a security, they want to have a pristine property in the pool because it is sold out into the market without a portion of it without a Freddie Mac guarantee. So they had an issue with VLI. So I would say from June through now, they've made a major push to facilitate VLI deals. And again, it's the Section 8 deals, it's the properties that will get that. They'll buy a pool of loans that do have a VLI credit to it, but they've really made an effort to go to the VLI. So obviously for this group, you know, a Section 8 deal would be right in their wheelhouse to the extent that there's something out there that's available to be refinanced.
Can you tell us a little more about the VLI? Are we talking about project-based Section 8? Are we talking about loans that extend beyond the term of the project-based Section 8? Are there overhang issues that are being dealt with on the underwriting? When an owner is trying to make a decision between a Freddie or a Fannie, other than the size of the deal, what are the criteria?
Sure, well, let me just go on the VLI and then I'll talk about the decision, the Freddie Fannie decision. So I use Section 8 as just an example, but the VLI basically is saying that we'll take a rent roll and we'll look at the rents compared to the area median income. So if you take the area median income, 30% goes towards rent, and then if that is less than 50% of AMI, then that counts. So it could be, in the New York City market, you basically have very low incomes and high rents. So the average New York City deal does not qualify. I wouldn't say the average, I'd say the majority. So you go to other markets, and I'll just use Ohio, where you can just take a market rate deal. Someone walks in and rents an apartment for $400 a month. That's going to qualify. So it really isn't just Section 8. It just happens to be in this market. It's essentially only Section 8 properties that work. And it could be project-based contracts, or it could be individual vouchers. There's no requirement. We've worked on some deals that have exited NYAHMA, where there's a LAF agreement with the landlord and the tenants, where you have some market rate units, they're not getting credit, and you have some units who are getting Section 8, and those would qualify, that portion of it. So the real test is the rents relative to the area median income, but I just use the example of New York City. Unless you have a Section 8 deal or an 80-20 where you have the 20%, there's really not much that qualifies here. So, and back to the Freddie Fannie question. So that is it's an extensive question of which works best, and I think, you know, without knowing the nuances of a specific transaction, you know, you could have a 20-minute conversation about your deal, and then you know, we could say, you know what, that's probably better suited for a Fannie Mae deal because of X, Y, Z, or vice versa. And we like to obviously get both executions, and some people come to us and say, I'll give you either Freddie or Fannie, which would you take? And then once we have that 20-minute conversation and we understand the nuances of the deal and the hot buttons that you're looking for, and we understand where Freddie and Fannie are relative to pricing, and if it's interest only, or if they're looking for a 15-year deal versus a 7-year deal, we like to have that decision. We could walk you through that, but it's a tough thing to just generalize which works better without having a specific deal to talk through. I didn't mention also, the agencies also write a fairly big book of floating rate business. So it's a LIBOR-based program, anywhere from 5 to 10 years, and you get a LIBOR-based spread. Say, you know, right now you're probably in the 275 to 300 over LIBOR, so you're paying a 3.25 to 350 coupon. That does have the step-down prepay option available. A lot of people use that as a bridge. They're going to buy a property, they're going to rehab it, so they're going to take that loan, rehab some units, come back, and then put more permanent 10-year fixed rate.
Beside capital.
So there's two programs with that. There's an external cap that you can buy, or they actually put their own internal cap in it. So obviously with the internal cap, it's embedded in the spread, and your rate will be a little bit higher. But you know, and depending on the term, when you get an internal cap, it's for the life of the loan. So if you're doing a 7-year loan, you think you're out of that in 3 years, you're kind of wasting that value of that 4-year cap. So that's something that we would advise someone, you know, go out and buy a 4-year cap. It's 40 basis points, much cheaper than embedding that in your spread for 7 years, which may be 70 basis points or whatever it is. So you know, another good program for the agency side. So basically, Freddie's made a big VLI push this year. They're on track. In fact, you know, consistent with their mandate to reduce their existing portfolio as well as get the VLI units. Towards the end of the year, they sort of combed through their portfolio. Everything they've done prior to 2007 was a portfolio lender. Now they're a securitized lender. So they looked at their old book of business and said, okay, we need VLI units. let's go through our existing book of business and see what's available that has VLI in it. And they basically reached out to the borrowers on those deals and said, we're gonna let you refinance this, we're gonna waive your prepayment penalty. You're gonna go into a much better interest rate because we get to book the credit for those VLI units this year. So that's kind of the, that was the 11th hour push to get these VLI units done this year. They just recently did that. If anyone's in the room taking advantage of that, it's a great program, but there's only been a handful in the New York market that have done that way.
So,
Is that just Freddie or Fannie?
That was just Freddie.
so Freddie now is actually waiving. That must be pretty recent. I actually went to Freddie February, March.
Yeah, so they did that if you had a VLI rich deal. So that was probably over the summer. They reached out, and I think it's only been about 3 deals in this market that they've done
This
that.
actually, I have a project-based section.
Yeah. Is it over 200 units?
Yes.
Okay. And when was it originally done?
2005, yield maintenance in 2020.
That's something you should talk to your lender about.
Because at the time, at the beginning of the year, they offered me 1 month.
1%.
Well, no, the write-off, my yield maintenance is very substantial.
Yeah.
What they offered came out to about 4 or 5% of the yield maintenance. It was ridiculous. It was
Yeah.
like no help. I mean, it was 1 month out of 70
Yeah.
they were gonna let me walk from, but if they're now talking real, that's good to know, thank you.
Yeah. Yeah, they did it. It had to qualify for 200 units and VLI credit if it's project-based section and you're there.
Right.
So I would call your lender, whoever it is on that.
Right.
And have
I
that
would go back.
conversation. Yeah.
Thank you.
The other qualifier is that it's got to close this year.
Is there any similar interest in Fannie or not?
So Fannie, by virtue of the smaller deals and the less in New York City, high-end market, they never had an issue with it. So they just automatically qualified just by the normal flow of their business. So they did nothing.
No, I meant on the yield maintenance. We happen to have a Fannie deal that has a high.
Yeah, Fannie won't do anything. Because the Fannie deals, as I highlighted, the Freddie, like your deal from 2005, is in their portfolio, so they have the ability to waive that. Fannie deals were all securitized, so they didn't have the ability. So an investor owns that, so they can't do anything on that. So it's a good question because a lot of people have comments that I want to refinance. Can you give me a break? So Freddie will waive 1%. That's probably you said 1 month. 1% of the UPB from yield maintenance doesn't do much for a lot of people. On a case-by-case basis, they've waived more. And when I say case-by-case, probably about 15 to 20% of the deals. And the reason why it's a case-by-case basis is because they've hedged all those deals internally. If they unwind the hedge and just profit in them, they'll waive that profit to get a new deal, get that loan off their books and get it to a securitized product. But they've actually taken the hit to hit their VLI numbers this year. So,
Okay, great, thank you.
any other questions before I just jump into a new Fannie program that's come out? So yeah, Fannie never had an issue with VLI, and unfortunately they don't waive yield maintenance as well. It's gone out to the investors. But so just one last thing that Fannie has come out with that we actually have a designation to process here is what's called their Empire, M-P-I-R-E loans. And what that basically stands for is Fannie Mae has formed a partnership with an independent not-for-profit in New York City called the New York City Energy Efficiency Corporation. And basically what they've come out with and said, New York City has a number of local laws and a number of greener building program. And in conjunction with that, a lot of owners are going to need capital to rehab their buildings, put in energy efficient lighting, appliances, windows, boilers, roofs, so on and so forth. So they're going to need some capital for that. So Fannie has come out with a program basically saying, if an owner wants to do this program, they're going to lend capital on it. They're going to provide either a supplemental behind an existing Fannie or a new Fannie loan program for it. They can't go behind another lender, unfortunately. But what they do is they get an energy audit on the property. They're going to look at what the engineer recommends in terms of energy efficiency improvements to be in compliance with New York City laws. They're going to do an assessment on how much that's going to cost, and they're going to lend on that money based on the fact that after this loan is done, you could underwrite less fuel, less electric, all the energy efficiency savings, less repairs going forward. You could underwrite all the energy efficiency savings that are post-rehab, but they're going to give you the money up front for that, and assuming that the loan sizes out and underwrites after the rehab's been done. So it's been well received. Again, unfortunately, the deal's either got to be up for refinance or an existing Fannie where you can do a supplemental to provide for these funds. But we have actually 2 underway. One of them is a rather extensive program, so the energy efficiency audit's taken a few months. But they're going to subsidize this program by having, significantly below market rates on that. So you could look at a new Fannie deal, a 10-year deal is probably about 5% now. We estimate it could be 75 to 100 basis points better than that when the deal comes out for pricing, once they go through the energy audit and get that deal closed. So,
Can you piggyback weatherization money on that?
if you get a NYSERDA grant, you can. Yeah, that counts as well. So that's exclusive of this program. So if they get any New York State help, that's available there. It's really a win-win-win because you're going to get a borrower who's operating a property that's lower cost to operate, and on an ongoing basis it enhances property value. Obviously, the property is going to go through a major rehab, so from a tenancy standpoint, you're looking at a lot of upgrades, much more energy efficiency building, and obviously compliance with New York City local laws and the greener building laws. So again, sort of small window of the deals that can be done because it's got to be open for refinance or existing Fannie, but clearly a good program. We're excited about it.
Can that be done as a credit enhancement for bonds and a tax credit deal?
As like a taxable tail?
No, in other words, if you do an HTC bond with a Fannie credit enhancement, would the lower rate be available?
Yeah, it's a good question. And about 3 years ago, Fannie essentially exited the tax credit enhancement business.
Oh, okay.
So Freddie is really the exclusive tax credit enhancement business. In fact, we closed an 80-20 new construction deal this year with Freddie. But Fannie really, while they say they're in that market, they're just priced out of it. So you either go on a bond letter of credit or you're taking a Freddie deal. But, it's a good question. But, I'm sure if there's an existing Fannie Mae credit enhancement on the deal and you come in as a taxable tail supplemental, it's something that can be done.
All right.
Yeah. So, but obviously it'll have a better rate, but it'll still be taxable tail. It won't be an expansion of the credit enhancement. So.
Got it.
Yeah, that's pretty much what I have. The 2 new programs, Freddie on the VLI and Fannie on the Empire, and then obviously the agencies are still relevant nationwide. They'll do almost $56 billion this year. So it's some good programs. The other one little nuance that Freddie came forward with just this past week, in fact I didn't put notes down on it, is obviously the HUD process takes a longer period of time. Freddie sort of capitalized on that and said, we have an early rate lock program where you basically come in with some certifications, you get a quote, you can rate lock up front for closing 120 days forward. They've sort of enhanced that a little bit more, and they've come out and said, once you send a deal in for a quote, we're going to issue you a quote sheet and a rate lock sheet. And you put up 2 points, there's no breakage fee on it. If you walk away from the rate lock and don't close, you're out the 2 points. But it's they call it an enhanced early rate lock. So if anyone's done an early rate lock, this is actually quicker. You don't have to send in all the forms, all the certifications. And it's basically, the plan is send a deal in and lock within 3 days and then close within 120 days after that.
Michael, before we let you go, if you just to underline for everyone the differences between the programs, some of the benefits, the flexibility, especially that Fannie has vis-a-vis FHA, that you can target whether it's your 5-year interest only or something. Also your timing. Timing is the big issue. In other words, not just for the rate lock, but from when someone comes to you until they get their bucks to do the next deal. And also some of the requirements that are not found, just so they can compare. Appropriation risk is the big thing. You may want to go into that. PCNAs aren't as intrusive as the HUDs are now, but you do layer on the interest rate risk for the appropriation risk for Section 8 deals. And yield maintenance was a big thing. I think now that the market's going the other way, yield maintenance is not as big a deal, but you also have those very strenuous yield maintenance.
That's exactly right. So again, you nailed them all there, but I'll sort of piggyback.
I want to lead you into some of the
So both Freddie and Fannie relative to HUD, you can go anywhere from 5 to 30 years. There's flexibility on the prepayments in the sense that we do what's called a 10-7, a 10-year loan. Historically had 9.5 years yield maintenance. You could buy that down and have a 10-year loan with 7 years yield maintenance. So I won't say it's 100% customizable, but it essentially is. If you have a capital need or need to sell a property or need to do a floating rate deal for 5 years and sell it off after 3 years, you could structure a deal where you have a 1% prepay for 2 years and then open a bar for the remaining 3. So it's not 100% customizable, but it's customizable enough where we feel it hits pretty much everyone's capital needs on what they have. Fannie also underwrites a little bit, a little bit behind the curtain. Fannie underwrites to an underwriting floor, and so Freddie underwrites the actual coupon on the rate, and Fannie underwrites the underwriting floor. This is probably a question of which is better or worse. If you're going full leverage, especially in a market like New York where cap rates are 5 and 6%, your underwriting floor is going to constrain that loan. So if someone's coming to me and they're buying a 5 cap deal and they want max proceeds, by definition, the Freddie coupon, let's say it's 5% versus the Fannie underwriting floor, let's say it's 5.75. Just using the same NOI, you just get more proceeds on a Freddie deal. So I would say take a Freddie deal in that situation. What Fannie has done, which is an interesting little nuance, is they have underwriting floors up to 10 years. If you go with a long term beyond 10 years, there's no underwriting floor. So they've created this 12-year product. And basically all it does is circumvent the floor. So you could do a 12-year loan. You could, instead of having 11.5 years yield maintenance, you could do a 10-year yield maintenance. So essentially, you're getting 2 extra years on a 10-year loan. You're not subject to the floor, and you're being competitive with Freddie Mac on loan proceeds. And if you like the coupon, you probably liked it 6 months ago better than you do now. You get an extra 2 years of financing, and you can prepay that at, in 10 years at par. So, so there's, you really have deal people working at both shops that they become creative, and that's helped in getting a lot of transactions done over the last couple of years. Timing and third parties. So both agencies have an early rate lock program, and Freddie just enhanced it, as I said. You could essentially send a deal in if it qualifies, and you like the spread that they're giving you, and you say, you know what, I want to do it. I don't want interest rate volatility over the next 90 to 120 days while you do your third parties. I'm going to lock it now. Or, my loan comes out of yield maintenance in 4 months. I'm going to lock now because I like rates and they're going to move up over the next 4 months. Let me lock this now and pay off in 4 months, and hopefully my yield maintenance will come down because I've waited 4 months to pay off. They have that, so that's something that you get an early rate lock. On a typical deal, rather it's earlier, a lot of people say, how quickly can you close? And it's kind of a loaded question because 3/4 of that lies within the borrower and getting us the information that we're going to ask for. It's clearly not as intensive as HUD, but we look at every property. We're going to ask for 2 years historicals. We're going to ask for a rent roll. We're going to ask for a T12. We're going to ask for a certification of the borrower's credit. We're going to ask for an organizational structure. We're going to ask for a key principal assignment, essentially what's called the carve-outs. If you get that stuff to us day one, you could be in and out on getting a deal done. I'll say 30 to 45 days. And that's assuming third parties take 2 to 3 weeks, but I would say 30 to 45 days from the day you walk in the office to the day you actually go to the closing table. So it could be done quickly. We've done deals in a quicker amount of time. If someone's under the gun, they have a contract, they have to go hard, and they don't want to go hard without a loan. We've got stuff done in 27 days, 26 days. So clearly, again, the ball's in the borrower's court on that. We do get the third parties. If you have an engineer or an environmental consultant or an appraiser that you'd like to work with, we're the one who has to accept that vendor, and we're happy to take someone. So a lot of people come in and say, I'm going hard on this deal, and I have my own engineer who did an assessment of the building. Will you take his report? As long as he fills out the correct Freddie or Fannie forms, we'll do that. So that speeds up the process a lot, and it's a lot more flexible on the third parties. We'll show it to you, and the engineer may have replaced the roofs in year 5, which adds to the replace reserves, and you can have a discussion, and maybe it goes to year 7 or year 10. And so there's some flexibility on that side of it. The HUD programs have been great. Unfortunately, as rates have gone up, people have gone into a HUD program 6 months ago at 3.25, 3.5, and then they come out at the back end with a commitment, and they're at 4.75. So definitely from a standpoint of interest rate volatility, it's the way to go. The Freddie deals have defeasits, the Fannie deals have yield maintenance. The two sort of positives on that is in a rising rate environment, yield maintenance is essentially nil. If rates keep going up, if you prepay in 3 years, that's you have a below market coupon. you're not going to be paying any much in yield maintenance. Freddie has defeasance, and what they offer, again, if you don't want to sell the property with the existing debt, or you do want to pay it off for any other reason, they offer what they do is a sort of in-house defeasance. It hasn't been done yet because no one's paid off any of their loans over the last 3 years and done it, but what it essentially does is they'll issue a security and they'll use that as a security to replace your loan in that pool of mortgages. So, you know, that theoretically will save a lot of defeasance costing because you're not going out to a third party to go out and seek out a security and you're paying them a fee. It's actually sort of an in-house defeasance. And again, I haven't gone through that process yet, but it sounds like it makes sense.
Appropriation risk, yes,
Appropriation risk, it's more political risk in terms of how FIFA comes back this year. So again, you know, in March of this year, to the surprise and dismay of senior officials at Freddie and Fannie, they came out on the multifamily side, and I think it was Lockhart in his speech just said, oh, by the way, you know, Freddie and Fannie have to reduce 10% this year on the multifamily book. So that was, they took them by surprise. I don't think anyone knew that was coming. The question is that going to be the case for next year? And I think no one knows that yet. So it wouldn't be an appropriations risk, it would be more of a just a regulatory risk. Any other risk you mentioned?
No, you got it. Thank you very much, Larry.
Thank you.
I bring up appropriation risk for Section 8. I'm a big believer that, having been at HUD and follow all the HUD programs, that the only program that will stay constant and grow is project-based Section 8. I think the Congress is showing, and HUD is showing, that operating subsidy and capital subsidy for PHAs are going down, that the voucher account is going down, and there's going to be cannibalization of vouchers. CDBG program is going down and we reduce, and the only thing that I say 10 years from now is going to stay constant is project-based Section 8. So that's why RAD is such a great program, but that's for another seminar, and I think there's really less risk. And basically, there's a difference in HUD think between the relative responsibilities of the federal government and the local governments versus there's only one program that HUD has that's a contract, and that's our house. And I don't think that Congress or HUD is going to abrogate that contract. Well, everything else, they can just say, well, you should go raise money, local PHA, and go fund the difference yourself. Anyway, getting on from that, that's a good lead-in to our HUD people here. We're here to talk about why some of the requirements they have and how HUD is looking at it and the burdens and responsibilities they are putting on your various lenders, your lenders at FHA. And unfortunately, although your program says that Diane Lima is going to be here, who's the head of production and asset management, she was unable to come today, so she has sent a very able person, Armand Marchand, is that? Marcia, who's the project manager in project production, and she came to HUD in 2012 from LOMAD. LOMAD is a contract administrator out in California, so she not only switched sides, she switched coasts. And we're very lucky to have her in New York, and she brings an expertise, as her boss does, Diane. We're very lucky to have that. Very often, production people at HUD, and this used to frustrate me when I was multifamily in Washington, that don't know anything about the asset management side, that production. I think it's very healthy, and New York is good about this, and I'm glad to see you too, that have an understanding of the operations as well as just underwriting. So that, Armin?
My name is Christina Graff. I'm also project manager with HUD. I've been there about a year and a half in asset production. So firstly, I just want to thank everyone for coming. One of HUD's main priorities is to preserve and extend affordable housing. So it's wonderful to be speaking to owners and people involved in that. Basically, I don't want to reiterate what Mr. Evan Williams had gone through in terms of the details of the program. What we're going to talk about a lot is sort of what happens at HUD and how you can make, as an owner, your applications move as quickly and smoothly as possible. So in case you haven't worked with HUD before, generally what will happen when you have an application is you're going to work with your lender initially, your MAP lender. You'll approach your lender, you'll go through your application process, your disclosures. The lender will get all the application information, all the exhibits together, they'll review everything, do underwriting. Once they're comfortable and at their normal state, with the loan for recommendation. What's going to happen is you'll be invited to come into HUD for a concept meeting. That will involve the MAP underwriter, the owner, management agent, primarily. And they're going to come in and present your application so that HUD can take a preliminary look at the application and say, okay, you know what, when you actually submit this, address this a little more strongly, make sure you update this, and also update you and the lender of maybe some of the latest regulations, mortgagee letters, and changes that have happened recently. So that when your application comes in, it's as complete as possible, so we can move as quickly as possible. Your lender will then go back and, depending on their procedure, finalize their third-party reports, package everything up, finalize all of the information, make sure the underwriting reflects all of your exhibits and that you guys are all comfortable. The lender will then submit the loan to HUD. So at that point, our goal is to take 45 active processing days to review your loan to get it to firm commitment if you're talking about a 223F program. If you're talking about a 223A7 program, our goal is to take 30 active processing days to review your loan. If you're talking about a 221B4 program, our goal is to take 60 active processing days to get to firm commitment. So once the application comes into HUD, a project manager will be assigned and a team will be assigned. Presently, the way our structure works is we have a project manager, and as was mentioned, we have specialties, technicians with each project manager team. So you'll have a valuation technician, you'll have an environmental, an engineering architect, mortgage credit. If you have a Section 8 contract or you're already HUD insured, we'll bring in your asset manager to just look at the history of the project. And if you're doing a separate hybrid reconstruction, you might have a market analyst as well. So what will happen is we'll do an initial review of the application just to make sure it's complete, all the exhibits are there, there's nothing major missing, or unaddressed in the underwriting. We'll then put the loan in with our technicians and start our active processing. We'll come back and coordinate directly with your underwriter, with your lender, about our findings, about anything that's missing. We would like some more explanation, we would like some updates, and that's when your lender may come back to you and say, hey, listen, HUD came back to us, they have this list of items they would like to be addressed, and they need some more information from you. So the lender will do that. Once the lender returns to HUD with a package of the responses, we'll review that, and we'll issue our firm commitment for your loan, as long as everything is in order. So again, I don't want to reiterate the details of the programs, but generally, most of the loans we have coming in right now are 223F refinance transactions. I want to just share a couple things with you that might be important as owners to know, again, to facilitate your application. If you already have a HUD-insured loan, or if you have your Section 8 contract, it's important to remember that when you submit your application in with your lender, there's going to be an impact on your reserve for replacement account. We don't want to see that balance shifting around because that's going to affect your underwriting. And you don't want to have any last minute, uh-oh, my balance is much lower than we underwrote it at. So you want to make sure that any of your draws on your reserve for replacement are done and that your lender's aware of it and underwrites accordingly before the loan gets to HUD. So we don't have a moving target. 223F programs account for critical and non-critical repairs. And that is specified in your PCNA report. It's really, we really encourage you as owners to review your PCNA report. Sometimes it seems that there might be a little bit of a surprise in terms of how things are laid out in the reserve for replacement schedule as part of the PCNA report. That maybe, if you're fully familiar up front, you'd be more, there wouldn't be questions sort of later on in the process. But your PCNA report is going to specify out the repairs, critical versus non-critical, as well as set up your reserve for replacement schedule for the ongoing years. As owners, you'll want to make sure that your critical repairs are addressed as immediately as possible. Obviously, your critical repairs will have to be completed before your loan can close with HUD. So as long as you know what those repairs are, you can get started as soon as you're actually able, especially if they end up being substantial, because the last thing you want is to have a firm commitment issued and then it's taking longer than you expected to get your critical repairs done, and that's what's holding up your closing. Also, what you want to be aware, especially in New York City, if your property is here, are violations. In the New York City area, several of the violations are listed as critical repair items. And as we know, violations can kind of be a moving target, and they kind of come up throughout the process. When you do get to closing, the title company, as you know, is going to run more reports, and if there's new violations that appear, we're going to need them addressed. So we really encourage you to keep up on checking on your violations and making sure that they're being addressed, and not only addressed, but fully cleared of record, so that doesn't hold up your closing. So that's another tip that we like to share. The 221D4 program, we won't get into much, but again, it can be used for sub-rehab or new construction. It usually has a longer term, as was mentioned, and it has a higher threshold. If you're using it for sub-rehab, it has a higher threshold for repairs. There is a limit between a 223F program and a 221D4. One of the main differences is the amount of repairs that you have to do in a project. So the details of these programs obviously get into with your lenders for your specific circumstance. The other program that was also mentioned is the the A7 program. The A7 program, we had been getting quite a number of these, especially when the rates, were quite low. We are able to move faster on those. The HUD fees are lower on those. There's no cash out on those, but you can do, the repairs that you need up into the 223F program limits. And of course, we've got the interest rate reduction program, which is a new program. We haven't had too many of those come in yet. But once again, that's not taking any cash out. It's not changing the term of your loan whatsoever, but it is reducing your interest rate. It's usually a pretty quick process. There is an application package that your lender sends in. There's not too many items on there. You shouldn't need a PCNA for that unless you had been in default within the past 24 months. Then you may need a PCNA for that. The next is a few other things I'd like to mention for possibly nonprofit owners. Is many of you have tax abatements on your properties, especially if you're presently a Section 202 project. We always like for you to understand the nature of your tax abatements and if the tax abatements will terminate at the payment of your mortgage. Especially if you have a 202 project in the city, you probably have a pilot program, the pilot shelter rent tax assessment. In the city, you will have to extend that before you close on your refinance of your loan. And that can be a lengthy process. So right up front, when we have our concept meeting with you, we try to ascertain what kind of other tax abatements or other funding sources that you have to make sure that they don't expire or have issues with the refinance of the mortgage. So that's something you're going to want to keep in mind. Finally, when we move down to the closing of your loan. So after the HUD issues your firm commitment, firm commitments are good for on a 223F program for 60 days, an A7 program for 90 days. They can be extended if needed, but obviously we all like to see your loan close as quickly as possible. When it comes to closing, your lender and your lender's counsel will put together the closing package and submit it to HUD. On the production side, we will review your closing package. Also, on HUD's legal side, of course, they will review your closing package. The best thing to do with your closing packages is usually related to your lender, but you just want to make sure that all of the special conditions that are listed on your firm commitment are addressed and included in the package right up front. And again, those repairs and those violations are something that the owners can really have an impact on, and the management agents, of course. What we did have a mention of that the loans are non-recourse. I just wanted to throw in there that the regulatory agreement now does have a stipulation about there's a section 50 to it, which just states if there is some kind of obvious malfeasance or fraud, that there is going to be a separate person named that there may be further issues with. But then again, that's with your attorneys, they go through that. But by and large, it's a non-recourse loan, so it's pretty good. Other than that, the closings are usually, the attorneys and HUD Legal usually work on that together. So, you guys just show up and sign. Right? If it was just that easy. But again, we are doing our best to move the loans as quickly as possible in active processing, of course. When it comes to updating reports We're waiting for documentation to get to us. Of course, we don't have control over that, but when it comes to the work that we do our best to move everything as quickly as possible. So that's what I would like to discuss with you. We have Armini here that's going to talk about our firm commitment budget authority and some after closing items that you may want to be aware of.
Hi, everybody. Okay, and I know Mr. Williams had touched upon the continuing resolution and firm commitment authority issues, and basically Congress has not passed a budget for this yet. However, we, based on this, HUD came up with 3 different priorities, and clearly affordability is the main priority. Priority 1, we actually, if you're aware, came out with the Hurricane Sandy notice, which basically is expedited processing, which we try to close the loan within 30 days. For all projects actually within a few counties many counties I should say, in New York and New Jersey, applies to basically using 30 days from application to firm. So that is priority number 1. We've actually had about like 35 to 40 concept meetings, I want to say, with interested borrowers, and have had 0 applications thus far. It is a quite extensive process, but that's probably why we've had 0 applications. Priority 2 is basically just all our affordable projects. That's what's being pushed through. And lastly, 3 is our market transactions. 2013, October 2013, we'll start the new fiscal year, and hopefully we'll get something by then, but no change in the budget authority as of yet. And just to touch on some of the post-closing issues, and that's going to deal with more on the asset management side, and this will be functions such as electronically filing your FAS, REAC, your management occupancy reviews. So that's pretty much it. And again, just to touch on the reserve for replacements disbursements, they have to follow that schedule that was in place. And these are all just the few post-closing requirements that are going to be in place. So at this time, we'd like to take any questions that you guys may have. Yes.
Hi, Christina.
Sure.
On the section 202, section 223 of refinancing,
Yes.
with the pilot agreement, get that extended, does that have to be in place at the time the firm commitment is submitted, or can it be at closing?
Okay, so what we've been doing is, because just from experience, again with the city and the city processes that must take place, because of the amount of time that tends to happen, what we've been putting in process in our offices is when your firm application comes in from your lender, we like to have documentation that you have submitted your application to HPD for the extension of the pilot. Ideally, it would be great if it was farther along than that, but at least we're looking for that, and we will tell you that at your council meeting. Once the firm is issued, we will issue a special condition indicating that at closing, we need the actual approved, signed, and passed city council resolution extending your pilot. So sometime between submitting your firm to application to HUD and closing, you need to get you need to have your application to HPD. You need to get it looked at and approved by HPD. They'll issue a speaker's recommendation letter confirming the tax amounts and the terms. Put it on the calendar with the city. The city will vote and approve it. At closing, we need that approval.
If I can sort of comment on that, the borrower's attorney sort of emphasize for the audience a number of the points you brought up. The tax abatement extension involves one sort of coordinating, and HPD and HUD have come a long way in terms of talking with one another, because HPD doesn't have the manpower to do stuff too early. On the other hand, as you know, it can hold up your processing. But that process involves a lot more than just submitting the application. They may want their own disclosure forms of the principals and have their own IG clearance for the principals in addition to the 2530 approval. And that really takes time. So getting the package in, getting the two agencies to talk to one another is really important. And HPD tends to remember, well, you pushed us last time and you didn't close it HUD for many months later, and so this is real, and so it's important to coordinate and get it done. The issue that you raised about violations, I certainly learned. Most my clients think, well, we got the PCNA, we know what the critical repairs are, we took care of it, and then we run the title report and get the searches close to the closing. And I know that you guys run this on a daily basis, and the violations, especially in New York, keep cropping up, and it's a problem. And there was a reference to fast. These are all old, many of them are old projects. So you got to get your attorney to go back, number one, and make sure there aren't outstanding fast issues, because you're going to hold up your closing,
We do look for
because
that,
all
yes.
of this is from experience.
Yes, no, I didn't mention that, you're right.
And the other thing is, have your attorney take a look at the old org docs, because one, the map guide requires a lot more now in the organizational documents, and amending a not-for-profit certificate of incorporation takes time, and you've got to deal with a whole other agency. So all of that's important to help you reach the goal when you close.
That's an excellent point. Again, regarding those critical violations, we're talking about DOB violations, fire department violations, ECBs, and HPDC violations. Those are considered the criticals. So again, whether it's the owner or more likely the management agent who runs or does searches every week, every month, whatever it is, I encourage you to keep up those efforts, if not redouble them during the application process, because if something crops up or if something that's on there that didn't come on PCNA, it'll be seen at closing and you want it addressed and cleared. When it comes to existing insured projects, absolutely. One of the things we do when we speak with the asset manager and look at the portfolio ourselves is we're going to look to see if you have any open, fast findings. And if you have, we're going to have them addressed before this refinance firm application can be issued. If you have issues on your MOR findings, if you have below failing REACT scores, all those things, they're going to need to be addressed before the firm commitment is issued here. And furthermore, your 2530 previous participation, you're going to want to make sure, and I would suggest enter into the app system and double check that all of the management agent principals and your principals as the owner are registered in the app system and the information is correct, social, name, address, all of that. And depending on your portfolio, that your scores of your other projects are updated in the system. As you may or may not know, you can submit your apps to us either electronically with your new firm application, or you can submit it on the paper 2530 form. We always prefer electronic, especially with the management agencies that happen to have large portfolios. It makes it easier, it's faster for us, in which case, again, you want to make sure that your portfolio scores are updated in the system before you send electronically to us. So those are really good points. And again, I don't have a say in this, but I guess my suggestion would be is to make sure you're working with your, your borrower's attorney right from the beginning, because again, for closing, there are requirements for your org docs and certain things that may need to be updated or extended. And just as I know the lender's working with their counsel to get the package together for you, as probably as soon as the firm's issued, I would imagine, they start as early as they can. So. Anything else?
Thank you.
Thank you.
I'd like to thank all of you for being here and thank our wonderful speakers who are really great. And it's a big thanks to all of you. We had two of the really good companies present their information, their experience, their work with both of them. I'm both happy and sorry to see that you're part of Capital now. There was something really nice about one of the very few independent mortgagees out there left. When I started this business, everyone was independent, but the way the world is, I'm sure it's good for you to be part of a little more politics, but a few benefits as well. there is, and that leads into the third, the second half of this presentation will be separately later in the fall. And I think HUD spoke very well about this, and that's what the managing agent has to do. And Gail Badger, as I mentioned, is one of our board members, and she just went through the largest 223F ever. I think it was $641 million at Co-op City, and they use Wells Fargo. And they're the third one, and Wells is going to be part of that presentation that Greg will be putting on later in the fall, along with Gail Badger, who spent a couple of years getting through that. Not a typical deal necessarily. We all know it took a lot of waivers to get through, but it did get through, and it'll be interesting to do it. We thank you all for your participation and for attending. For those of you that are not members, Greg, I'm sure, has applications. We wish that you would join. Oh, they're all on the table. That's great. Because then you'll get invited to all our seminars. And thank you very much.
And how
What?
about just,
What?
as you notice that we do film, and we have been filming from day one, and all our videos are on our website. But in order to access it, you have to be a member. All right? So that's one of the many benefits you have of being a member of NYAHMA. So just want to let
You also get a discount for all of these seminars and the project expenses. So that's good. Bye-bye all. Thank you.
Thank you.
Hi.